Hello everyone, welcome to Investing Kala or the art of investing, where we will cover different aspects of the stock market. Now there is always excitement when a new IPO comes, with people asking each other whether you should invest or not. With Swiggy's IPO right around the corner, a lot of people are asking the same question and whether it can give the same returns as when Zomato had listed. In today's video, we will cover IPOs and what should be the process to make consistent returns from IPO investing. By the end of the video, you yourself will become an expert in IPO investing. Now, before we cover the investing strategy for an IPO, what exactly is an IPO? An IPO is when for the first time a private company sells shares to the public. Take the example of Swiggy. Currently, all shares of Swiggy will be held by the founders, investors, or the Swiggy employees who are now looking to sell some of the shares to raise some money. What will they do with this money? This will help drive company growth, will help pay off existing debt, or very simply, it will help give a return to the existing stakeholders of the company. Swiggy is now giving you an opportunity to be part of its growth story. So if you are an investor in Swiggy and if Swiggy performs similar to Zomato, then you will make a return on your investment in the company. We will now cover the IPO listing process. The IPO listing process is a three-step process. Phase 1 is application. This is the phase where all investors place a bid to apply for the IPO. The second phase is allocation. Let's take an example of Swiggy. Imagine that Swiggy is only selling 100 shares and 1000 people apply to buy the share. Now in this case, different organizations follow different ways of allocating shares to these individuals. The most common process that an organization follows is they will randomly select 100 individuals who get the share, and for the remaining 900 individuals, the money is refunded to their bank accounts. The third phase, if you are lucky and have been selected as part of getting the IPO, is listing. This is when the share lists on the stock market and then starts trading. The whole end-to-end process from application to listing typically takes about 6 to 7 days. Let's take an example of Swiggy and look at what these phases are. In Swiggy's example, phase 1 starts on November 6th. Between November 6th and November 8th is when all investors will apply to be part of the Swiggy IPO. Phase 2, which is allocation, is on November 11th. This is where the company will decide who all gets the share, and for the remaining individuals, the refunds will get processed on November 12th. November 13th is the big day. This is when the Swiggy shares will list on the stock market. Having now covered what is an IPO and the listing process, let's come to the main topic of the video, which is how do you decide whether you should invest in an IPO or not? Now, whatever others might make you believe, IPO investing is not rocket science. Especially as a momentum investor, there are only two numbers that you need to keep in mind when you're deciding whether you should invest in an IPO or not. These two numbers are what is the grey market premium of the IPO, and second, what are the subscription numbers for the IPO. Let's cover these two in greater detail. So what is grey market premium or GMP? Similar to the stock market, there is an unofficial market in which unlisted shares can be bought or sold. Based on the demand and supply of the stock, there is an unofficial price of the stock in this market. The difference between this price and the issue price generates the grey market premium. Now, why is grey market premium important? The grey market premium is a very good indicator of the listing day gain that the stock will have when it lists on the stock market. And as a momentum investor, this listing gain is what we would want to capture. If we were to look at the upcoming IPOs and compare their GMPs, so for Sagility India, the listing gain is approximately 0%, whereas for Swiggy it is 5% and for ACME Solar it is 10%. Now, as an investor, we would want to see this listing gain number to be at least higher than 15%. Why 15%? This is important because the markets are inherently volatile. So there might be a case that in the case of a market which is going down, this listing day gain could be negative or marginally positive. We would not want to risk our money for this small gain. So as a rule of thumb, only invest in IPOs where the listing day gain is at least 15 to 20%. The second number that we are interested in looking at is the subscription status. Subscription status gives an indicator of the demand that exists in the market for the IPO. I will put in the description of this video the links of all the websites that we are going through so that you can yourself look at the grey market premium and the subscription status for these three IPOs as well as any future IPO that will come in. So how do we interpret the subscription status of any IPO? Let's take an example. Vari Energies was an IPO that came between 21 to 23rd October, which listed with very high listing gain. The key number that you should look at are these four. What does this represent? Let's suppose that the company wanted to sell 100 shares. The total number represents the oversubscription that the company had for those 100 shares. So in this example, the company only wanted to sell 100 shares, but it got bids for around 7,900 shares. Now in each IPO, the company will give shares to different classes of shareholders, which are represented by QIB, NII and RII. RII represents the retail investors. The NII represents non-institutional investors. These are investors who are willing to put in big money into the IPO. And finally, there is QIB. QIB are the likes of your mutual funds or large scale institutional investors who will put in extremely large amounts of money into the IPO. Now, the key number that you should look at is primarily the NII and the RRI, which are primarily large investors and the retail investors putting money into the stock or not. Now in this table, what you will see is there are certain good IPOs, for instance Vari, which was oversubscribed by 79 times, and then there are certain poor IPOs, which is, let's suppose, Hyundai Motor India, which was only oversubscribed 2.5 times. And this oversubscription, as we mentioned, is not coming because individual investors are putting in money. It is only coming because large scale institutions are putting in money in the stock. So summarizing our IPO investing strategy. As a momentum investor, you are only concerned with two numbers when you are evaluating an IPO. The first number is the grey market premium, where you would want to see a number higher than 15 to 20%. The second is the subscription number, especially that for NII and RII, where you would want to see oversubscription by 10x. Now, a small tip when you are investing in an IPO. Don't be in a hurry to invest. Always wait for the third or the last day of an IPO before you decide to invest in it or not. Why do we say that? Because you will get the best view on demand of the subscription numbers as opposed to someone who's only applying on first day. You will have equal chance of allocation whether you apply on the first day or the last day, So make full use of the information before you decide to put in your money. So what next? You now know whether you should apply for an IPO or not. And congratulations, let's suppose you get the IPO as well. No strategy in the stock market is complete without you knowing when you should get out of the stock and realize the profit that you've made. Now, in IPO investing, as a momentum investor, your primary objective is to capture the listing day gain that you will get as part of the stock listing. Depending on your risk appetite, there are two options that you have on when you should realize this gain. The first option is when you are extremely risk conscious. Then, on the day of listing, you sell 100% of the stock you hold. In the worst case, you will at least make 20 to 30% over the course of a single week. In option 2, if you are taking more risk, you can decide to only sell 50% of the stock on the day of listing. The remaining 50% you can sell based on the behavior of the stock. If the stock is going up, you keep holding on to the 50% till the time you see that the stock starts going down. If the stock goes down starting the second day itself, then you can realize the remaining 50% because that is pure profit that you are holding. So let's see our IPO strategy in real life. We'll take 3 examples to see what would be the gain that you will get as part of this strategy. Now, because we are discussing Swiggy, it's only fair to look at Zomato when it had listed. So in the case of Zomato, the issue price was 75. It opened on 115. So if you were lucky to have gotten allocation on the Zomato stock, you would have made 50% gain on the day that the Zomato stock had listed. Now, if you would have sold Now, if you had taken option 1 in the selling strategy, you would have net realized this 50% gain. However, if you had sold 50% at 115 and held on the remaining 50% till 143, your gain would have been higher. Let's take a second example. The second example is for Bajaj Housing Finance. This was also a stock which had come out which had 100% plus grey market premium, and its subscription numbers were also significantly high, and this reflected on the listing day gain. The issue price was 70, but when the stock opened, it opened at 150. So in the course of 1 week itself, you made 115% gain. If you would have held on to the stock for even 1 day more, it would have gone to 180, post which it started coming down. So the best strategy would be to sell 50% on the day of the listing and sell the remaining 50% probably on day 3 when you see that the stock is now starting to come down. The third example that we'll take is for Hyundai, and this is the same stock that we saw which had very poor subscription numbers. Now in this case, the issue price was 1960. Because of poor demand in the market, it actually listed at a loss of 1930. And on the day of listing, it further fell down to as low as 1890. So, whenever you are investing in IPOs, always keep the two numbers in mind, which is what is the grey market premium, and second, what are the subscription numbers which show whether investors are actually interested in the stock or not. So having discussed the process, all of you are now qualified to take a decision on any IPO. You can evaluate the upcoming 3 IPOs based on what we discussed, right? Which is what are the listing gain, and second, look at the subscription numbers on the last day of the IPO. So you will take a decision on Sagility India on 7th November by looking at is there demand in the market for this IPO. Similarly, for Swiggy and ACME Solar, take a decision on 8th November. So you can comment on the three on whether you are applying or not in the comment section below, and let's see what the answer is. You can see the live GMP of the stocks in the link that I will share in the description. So that wraps up today's video. Hope you liked the video and understood the process to go about IPO investing. Please like and subscribe so that more investors can understand the process and take decisions on their own. Thank you and see you in the next video.